Welcome, everybody, to the Thursday edition of the Not Your Average Investor Show. We are live from the JWB studio for the JWB Rental Income Property of the Week. Today, we're going to 8623 Austin with a brand new construction with property insurance costs under $500 per year. And you will have a 2 or 3 year lease signed, and they'll deliver over a 7.6 estimated ROI. I don't even have to wait for the camera to switch because we're officially live in studio for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Income Property of the Week. I am your host, Pablo Gonzalez, here taking this baby for a spin for the first time. And the guy that's been here all along, the man that they call GC because of his genius concepts, because he generates cash flows, and because he's a great co-host. His name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you here. Great to be with you, partner.
It's great to be here with you, man, to look straight into your eyes, feel your body heat.
Let's talk about this for a while. This has been on our list of high priority items for a long time to be here in the studio together.
It's a totally different feeling, man. It's totally like, I don't know. I feel like there should be like a screen here and you should be marked and there should be these different things. And now I'm going to clunk through the regular intro, but let's say hi to the community. Look at this. The chat's on fire. Lee Bishop's in the house. Carl Thompson's in the house. John Henning's in the house. Mark Larrett's in the house. Leo, good morning from California. Lou Carlson from Somers, Connecticut is in the house. Who else we got? We got Scott Belote. We got Mark Larrett. Did we already say Mark Larrett? I don't know.
He deserves twice the mention. Mark's a newer part of the newer crew that's here, and every single week we love having Mark.
It's true, Mark. We're happy to have you, buddy. And as you all know, this is the interactive show. Now, I'm going to be, normally I can look straight into the screen and look into the camera and look at you all at the same time, but I'm going to be living through it while I follow the chat. We want you contributing in the chat. The real trick to the chat, see, normally I'm doing all this other stuff. Real trick to the chat is there's a little screen on the bottom. There's a blue box where you're typing. That's defaulted to panelists only. That means only GC. Actually, only I see it now because I got the only computer in town, right? Mm-hmm. And so what you want to do is change that to panelists and attendees. And that way, everybody else in the chat sees you. A lot of knowledge inside that chat room. We've got very, very seasoned investors, and they can give you some great opinions and great testimonials themselves. And then last but not least, there's the Q&A box, which is on the bottom right as well. You pop that open. That's going to really, really help me out. Now, especially that we're in studio, I want to be looking at the camera. I want to be looking at you. I want to be looking at GC and his baby blues over here. And it's going to get weird. It's going to get so weird. And so just if you have a question that you want to ask about the property itself, if you want to ask about your personal journey, however you want it, right? Like go open up that Q&A, pop it in there. It's going to be the easiest way to keep track of it. And if you want to follow along at home, we got the website up. The property that we're going to look at today is there. JWBinventory.com. I got to practice not smashing this table because we got this really nice microphone here.
Don't break it.
And yeah, you know, I gotta turn off the karate skills that I've been trained in for so long. But yeah, go to JWBinventory.com, download the sheet. You can follow along at home. It's going to be what I'm tinkering with over here, and you're going to be able to tinker with it yourself. Greg, I think while our friends are downloading the property right now, we got some news, right?
We do. Which news are you speaking? I have a lot of news in my head. Yeah. Are we talking about?
I think there's some significant stuff coming out with a rent moratorium, right?
We can do that update.
Yeah, why don't we do that update?
I like that. I mean, before we go into the property, there's always, a couple of just talking points that either have come up in the group or clients have been asking about. And this eviction moratorium, it was interesting. I was putting out the talking notes for the show early. I had written up, hey, Pablo, I think we should give everybody an update on this. And then since I did that, there was an update on the update. So we'll give you updates on updates on updates on updates here as far as the on updates. week. So something to keep in mind here, if you guys are members of the Facebook group, I just posted an article there, which was breaking news yesterday that a federal judge overturned or challenged the eviction moratorium. Basically, the CDC has come out and they're the driver of the eviction moratorium, which basically says that, you cannot evict while we are enduring this COVID thing, for lack of a better word. So there's this eviction moratorium that's been out there for a long time, and it hasn't been scheduled to end anytime soon for months and months and months and all that good stuff. Well, couple things. A federal judge challenged that the CDC had the right to actually impose this moratorium. what this means for you as a rental property investor is absolutely nothing as I sit here today with you. There's no change to this. This is the beginning of a lot of litigation, but this is a big win for rental property investors and something that many investors and those who are, those, what are they called? Lobbyists. There we go. Lobbyists for rental property investors and those groups have been challenging this for a long time. So it is a legal step. It is a legal win for those like rental property investors who have been, seriously affected by not being able to evict. Nothing changes here today. So that was the update on the update. The one thing that I wanted to tell you about that not many people might be aware of, because quite frankly, before my property management team explained this to me a few weeks ago, I wasn't aware of it. But it comes down to what actually happens to those residents who we are, of course, bound by the eviction moratorium in Duval County. But when can you actually evict in the eviction moratorium while you're dealing with this? So a couple of granular details here that I think will be helpful for everybody. As it stands now, there's this eviction moratorium in place, of course, in Duval County. In Duval County, you can actually file for evictions, which is an important and necessary step. And so this has been the way it is. I've shared this with you guys for months now. So you can actually file the eviction. You can start the eviction. That's what that means. You can just not complete the eviction at the moment, because what happens is if you file the eviction and a resident then files what's called a CDC attestation, which is basically a document that says that they've been negatively affected by COVID, then you cannot evict while there is an active lease in place. So none of that is new news. That's the way we've been operating for months now. We go all the way forward with filing the eviction on the resident if, of course, that is the necessary step. What is new that I didn't understand, and that you may not understand as well, is that if your resident files the CDC attestation, and then the lease expires, many residents will leave at that point. So many clients have a fear of like, well, what happens if somebody has been filed a CDC attestation? Are they just going to be in my home for forever until this eviction moratorium ends? That's not necessarily the case. Many residents actually just leave when their existing lease is no longer in place, even if they've filed a CDC attestation. So that's a win, right? Not every resident does that. The next question I asked was, well, if there's a resident who filed the CDC attestation while there was an active lease in place, and they do not leave after the active lease, the lease has expired, if they don't leave, can you evict? And the answer is yes. What you do is you file what's called an amended eviction. There's a small cost to it. I think it's about $300. And we obviously will facilitate this for you as a client. And then you can actually evict a resident who has filed a CDC attestation as long as there is no longer an active lease in place, which is something that we are doing on behalf of our clients when that situation is of course, the right thing to do for all parties. So a little bit granular detail there, but you kind of see some positive momentum in a lot of different ways. For a long time, people didn't know that you could actually file the eviction, which is a big part of the process. And now you are finding, you're finding that you can actually evict if the active lease is no longer in place. So win all around.
There you go. Win all around. Good job addressing camera 2 over here, right? For those of us that are watching live, we got camera 1 and we got camera 2. Camera 1, camera 2. So I'm going to be messing around with it a little bit. Greg and I are getting used to this new layout. Greg, great update, buddy. So basically it means things are normalizing again. If they have this special permission, an attestation from the CDC, then they're allowed to wait out their lease, right? If they don't get the attestation, then it's the same game as before,
yeah.
Right?
No restriction on a moratorium as long as if they haven't negatively been affected by COVID, you can evict at any time. If they put their name and sign the attestation that they've been negatively affected to COVID, you can't while there's an active lease in place. If there's not an active lease in place, it's normal eviction proceedings like always.
Got it. Okay. All right. That makes a lot of sense. I want to catch up to what's happening in the chat because it's pretty funny, man. And I know that you can't see it, but so first of all, Lee just put a new property under contract. Congratulations, Lee.
Lee Bishop, way to go, buddy.
Yeah, we've got Linda and Doug here from Fort Wayne, Indiana. We got Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Home of the manatees, of course. We got Saba Hashem. Hello. She says hello, Pablo and Greg. Hello, Saba.
Saba, welcome.
Nadeem is back. Howdy, y'all. Good to see everybody. What else we got over here? Mark Larrett says that the chat, I guess, all right, since I am logged in under your account and I'm chatting in here, people are like making fun of the fact that stuff is being typed and your hands are moving up here. So that people are saying that you're typing kinetically. Touche.
There you go.
Touche. Touche. What else? All right, we're good here. So Yusuf Nasir's here. Welcome, Yusuf. Drew
Barnhill. He's a
Barnhill.
friend of mine. I told him to join the show today. I gave him some grief. I didn't think he was going to show up. So I'm glad he's here. Welcome, Yusuf.
I'm glad we called it. And Jen fills in as always. Good to have you in here, Jen. And now we are going to magically whisk away. Oh, you know what? We do have some questions here from the moratorium. We have all the way from France, Anonymous Otende. What is total average cost for an eviction?
You know, an eviction, total cost for an eviction, if we're talking about the attorney's fees is one thing, right? A total cost for an eviction, it's one of the worst things that can happen for you as a rental property investor. That's why JWB signs long-term leases and we renew leases and we qualify residents to make sure that we don't widen up in that spot. You know, total cost for an eviction, you could think about your vacancy cost, your maintenance cost after the eviction happens and you put the house back on the market. So you could go down that path. I think what you're specifically asking, though, is about the fees for the attorney to do the eviction, which is about $500. And that goes to the attorney to handle the eviction proceedings. We facilitate the entire thing for you. It's really just a cost for you. You don't actually have to do anything. We're handling everything for you. And of course, the attorney that we work with is wonderful at getting these things done quickly.
There you go. And Carl Thompson has a question. What do you mean by negatively affected by COVID? Does that mean they simply have it, out of work as a result of COVID, or question mark?
Well, you know, I would actually just, you know, ask you to do a Google search to find out the technical term of all that. I'm not, you know, I don't know everything there. If you just do a Google search for CDC attestation, you'll probably find the form right there. And it probably has, you know, 10 questions. Were you affected this way negatively or this way or this way or this way? So it is relatively broad, right? It's not, did you have COVID or not? Did you lose your job? Did you, you know, something else? So it's relatively broad, but it is important that they are putting their name, their signature, that it's not fraudulent. You know, this is something that, you know, it's like a loan document in a sense, right? You don't sign this thing unless you are really affected by COVID. You know, that's the intention there.
Okay. Makes a lot of sense. Now we are going to check out the property of the whisked away to 8623 Austin Street, where we have a 3-bedroom, 2-bathroom, lovely home here that seems like it's wrapping up construction, listed at $190,000. It's got a 2-car garage. It's got, this is a different screen, so I need to adjust for it. It's got a lease of 2 or 3 years, estimated at around $1,250 a month. And what you come here for, the thing that you are actually buying, is this estimated conventional financing total monthly cash flow of $126 per month and an estimated financing total ROI of 7.63%. Greg, you know what we're going to do? I'm going to turn on camera 1 and I'm going to ask you to explain to our friends what is included in this total monthly cash flow.
Wonderful. I'm so glad I have that opportunity. These are the 2 metrics that if you're thinking about investing in rental properties, you need to pay attention to first, right? You don't need to pay attention to how the property looks first, or, you know, some of these other things that might not be as important, right? Some of these things are important, but not as important as these 2 metrics. The first one is your total monthly cash flow. And you'll see here that it's estimated at $126 a month. What that should mean to you is that you're buying an asset that pays for itself every single month. This is so critical. If you can buy an asset that pays for itself every single month and then pays you a little bit more, you're buying a real asset, right? You are not buying a liability, right? A simplistic way to look at assets and liabilities, the way that I look at them, the way that I learned from Robert Kiyosaki, who wrote the book Rich Dad Poor Dad, is assets pay you every single month, liabilities you have to pay every single month, right? So when you're looking at $126 a month coming to you after all the expenses, that means that this is an asset, okay? What this also means is that it's scalable, right? Because if you're coming to rental properties, I would imagine if you sat down and you thought about what goals are with this asset class and how many properties and how much rental property income you really need to accomplish that goal, it's going to be more than one property. If you're like most of our clients, it's 5 properties, maybe 10 properties, maybe 20 properties. That's what it will require to accomplish that monthly passive income goal. Well, when you look at an asset that pays for itself every single month, the idea of you stacking more and more assets onto each other becomes a real possibility. It becomes fun. Whereas if this was negative $300 a month, which it is for many rental properties, especially in other markets across the country, I don't want to own 10 things that are going to cost me $300 a month. That's $3,000 I got to pay for a month, right? That's not nearly as fun or manageable or scalable. So that $126 a month, specifically the way you break it down is you take your gross rental income. So the rent that the resident is paying for you, you take out your expenses that happen every single month, your principal payments, your interest payments, your property taxes, your insurance costs, and your property management fees. Those are going to be there every single month when the house is rented, right? And what's left over is this $126. And I want to make one more point that I hope people can kind of just see and just get excited about, because you can tell I get fired up about it, right? What we're creating here is an asset that's paying for itself, but it's also incurring debt costs, right? This is the kicker. You found an asset here that you can incur debt, meaning you can borrow, you can use other people's money to be able to acquire these assets, but there's a cost for that, right? It's your principal and your interest payments, right? There's a cost for that. But you have an asset here that is paying you $126 a month over and above taking on the debt costs. You can't get that in other asset classes, right? And so if you think about the possibilities there, of course, it helps you earn a really high return on investment. It helps you scale. It helps you build a diversified portfolio of more than just one rental property. But I wouldn't be such a big proponent of using smart debt unless it could pay for itself. So that's what I look at. I don't look at this and I don't say, well, this is a great deal if it's got $100 a month or $126 a month or $150 a month, right? I care less about that. I care more about the fact that it is positively cash flow. It is paying for itself. It's an asset and it's scalable. And that's what it should represent to you.
I love it. And when you talk about, here we go, camera two. And when you talk about incurring debt costs, that to me means, right, like that seems like this like special term, but it really just means when you take out a mortgage, you're paying back your mortgage in a home, you're paying a little bit of interest on that mortgage. And, at the beginning it's more than less, right? And then you're also paying down the actual capital that you pulled out. And as it goes on, your resident that's in the home is paying down that capital, paying down that loan back, right? That's that debt cost that they're paying back. So no matter what, even and you'll see here that it says 0% appreciation rate, but like even in a 0% appreciation situation, the longer you hold it, the more that pay down is paying you back, because that is building equity for you on top of whatever cash flow situation or any other, positive force there is, right?
Exactly. You're starting to talk about other profit centers, even beyond just the net cash flow that we're looking at here with principal pay down, right? That 126 doesn't even talk about principal pay down yet. The next metric, of course, is when we're going to talk about the additional profit center. So you're talking about things that are even more beneficial than just simply what that 126 represents there.
Okay, well, I think we should talk about it then, Greg. Let's talk about this estimated conventional financing total ROI, 7.63%. That includes these other profit centers that you're talking about. Why don't you explain that for us?
Yeah, absolutely. So the first metric to look at is your total monthly cash flow on a normal month. That was that $126 a month estimated. The next metric is we need to look a little bit bigger picture, because the reason that the first metric is so important and why I talk about it first is because that's the threshold for this to be an asset that pays for itself every single month, right? That's one really important metric, but that's only looking at one potential profit center. And the reason that you should be coming to rental properties is because you should be fired up about 5 profit centers, not just one profit center. And you should know and learn and be educated on these 5 profit centers, because it's going to help you make the best decision for what to do with your money. It's going to help you choose the right market to invest in. It's going to help you choose the right team. It's going to help you choose the right asset. So you've got to know these 5 profit centers. So the next item that we look at is your total return on investment. And that's what allows you to capture all of the profit centers here. All the profit centers would be your cash flow, your net cash flow, which is what we had just previously talked about. Now we're going to talk about your principal pay down, which is what you were hinting at, Pablo. You've got your estimated tax savings, which is the money that you don't have to pay Uncle Sam every single year because of the tax advantages for rental properties. And then there's home price appreciation as well, which I'm sure we'll talk about at some point and how we evaluate that. The fifth profit center that's actually not calculated here is inflation hedging, which is always one that people aren't really sure how to evaluate that. For me, you know what? I didn't even put in our evaluations because people are unsure about it and the evaluations stand on their own 2 feet. But inflation hedging just basically says that, as the cost of goods and services go up around real estate's a hard asset, which means that generally your rents go up and your home prices go up in line with inflation, because as other goods and services go up, those are going to go up as well. So this total return on investment takes all the profit centers into account. I didn't put inflation hedging in there because it's tough to explain for everybody, but other 4 profit centers are included there. And what we do is we include all the good things for those profit centers. What we also include in that total return on investment is all of the bad things that will happen at some point over time, right? That will happen at some point over time, but that don't happen every single month. And so the negative items that you should be including would be your maintenance costs, your vacancy costs, your tenant placement fees, and then closing costs. We're gonna factor that in. So you take all the good things of the additional profit centers, you take all of the bad things of things that will happen at some point over time. You combine that, you run those numbers over your initial investment, and that's what gives you this estimated total return on investment of 7.63%.
Amazing. Really enjoyable to watch you just kill it on the camera right there from this perspective and just spit hot fire. When I think about it, I think, all right, so then that monthly cash flow is like the typical month, right? When there isn't something extraordinary happening, that's probably going to be like somewhere along the lines of 21 out of 22 months of the year kind of thing, right? Like,
sure.
Or more, right? Like when there isn't something that is a one-time thing that doesn't happen all the time happening. And then that ROI perspective is just that holistic view, not including the hedge on inflation, not including the appreciation, which we're going to get to in a second. But right now, we got a bunch of really good questions in the Q&A. Like we like to fire off the questions.
Let's do it. That's why we're here.
Yeah. So Galaxy S10e, I've heard that's a phenomenal phone. So that's asking us, would you talk about 1031 exchange and the new administration stance on this? How do you feel about this?
Oh, wow. Well, I'm probably going to steer far away from anything political when it has to do with the new administration stance on it. I have heard rumblings that this may be threatened. So let's start first with what a 1031 exchange is. A 1031 exchange is this amazing opportunity for you to be able to continue to invest in real estate, make gains on investments in real estate, but not pay the taxes on those gains as long as you reinvest those assets in like-kind properties. So if you're an investor in California and you have owned properties for a while and you just had huge equity gains from the appreciation of the property, you can take that equity, you can sell that property and not pay capital gains tax on that in the year that you sell it. The thing that you have to do is you have to plan in advance and you have to reinvest those gains in like-kind properties, let's say rental properties in Jacksonville, Florida. And if you do that, there's other rules to follow. Of course, if you have specific questions about this, reach out to my team, right? I'm simplifying this. But you can then take that equity, put it into maybe 4 rental properties in Jacksonville, and then you're not hampered by paying the taxes on that the year that you sold. So it's this incredible tax savings component. I have heard rumblings that the Biden administration was considering doing away with the 1031 exchange. I haven't heard much more than that. I heard those rumblings back when it was election season, and I haven't heard anything concrete to see that a step has been made forward in that direction. Generally, the impression that I have heard from others in the space, and I've talked to our CPA about it and a few others, is this has been something that's been talked about in previous administrations and hasn't come to fruition. So out of the things that people are worried about from a tax perspective, doing away with the 1031 exchange is not the thing that most people are most concerned about from a tax perspective at this moment, is the feeling that I have. And I hope it doesn't go away. I think that would severely limit the money moving in the economy. And I would think that there's other ways. So I guess I did throw in my ideas on that. So there you go.
There you go. I actually had to talk about this whole 1031 exchange stuff with Pop-Up, with Everett, who's a regular here over the weekend. The 1031 exchange to me feels like an amazing benefit that makes real estate just stand out in a macro sense as an investment, right? Like when I look at the investments that I'm making in this asset class, I think about the positive cash flow. I think about the ROI. I think of the 1031 exchange, and the option to do a 1031 exchange at some point is there. It's probably like my fifth or sixth thing that I'm considering down the line, right? Like I'm thinking about my risk. So I see this going away of the 10. Again, I'm just getting in now, so I'm walking in eyes open.
Yeah.
And if it goes away, it goes away. But I don't think that changes my opinion on this investment when I compare it to stocks, or I compare it to Bitcoin, or I compare it to, whatever. I don't know. Just is that kind of right, or how big is the 1031 exchange? Let's say it was to completely go away. Like, does it really change the game?
I think it's a big deal.
It's a big deal.
I think it's a big deal.
Okay.
Yeah, I think where you're at. You're in your second property with us right now, right? You're in acquisition mode, right? And you haven't had the benefit of time owning these for so long, where you haven't seen these huge equity gains, and you're not going to be selling these things for a long time anyways.
Yeah.
Right. So it's not important to you right now. And that makes total sense. But imagine that you're somebody who's in California, and you've got so much money in the stock market that is causing you real stress, right? Because you don't like the up, you don't like the down, can't really handle it. You would really love to have another stool of your portfolio. Like, you talk about a three-legged stool, right? You've got three different asset classes. A lot of people think and talk about that. You might only have stocks and bonds right now. You really like to have something like rental properties get in that asset class. And you're sitting on this property that's been in your family for decades. And you're looking at it and you're saying, wow, this could be my ticket to get into this rental property asset class. You might be sitting on $500,000 of gains there. Well, if you sell that property and you make $500,000 from the equity on it, right now you have to pay about 20% in taxes. So that's about $100,000 that you pay right back in that. That's a big deal. And going from $400,000 to invest versus $500,000 to invest is a big deal, and that could really kind of affect your overall financial portfolio. So I think where you are is exactly where you should be. This should not be the most important thing for you at this moment. But if you're in California, New York, Virginia, some of these high price markets, and you've been looking for a way to get into rental properties, and you're looking at selling your assets, this is a really big deal to those folks for sure.
Sure. I guess, and I don't have to belabor this point too much, but I feel like it's such a bonus, right? Like, yes, if I inherited a property and I wanted to exit it, cool. Like that's absolutely, I'm going to be upset that my tax basis is going to go up. I just feel like if I was to inherit my dad's stock portfolio and I want to, the same thing that you're saying, right? That person let's give a real example. Person in California just had a liquidation event, right? Because they just got their startup acquired. They don't get a 1031 exchange either, right? Like, so as far as what I'm going to put my money into on a today basis right now, yeah, it's going to lower my ability to buy something if I'm selling real estate to do this. But on the purchase decision, right? Like on the, I have this much money, if all else equal, I have $100,000 of something that I want to invest without counting whatever I have to sell to then invest it. On the purchase itself, the 1031 exchange is kind of like in the background.
Yeah. For your purchase decision, it's not really going to change the numbers on this evaluation. It's, and a lot's going to change from the time that you buy this property to the time that you may sell it and realize the benefits of a 1031. So yeah, you're right. It's not so much about the purchase decision for this house on Osteen.
Yeah. Cool.
You're right.
Okay. All right. So we got a great question that is something that we wanted to get into already, and it's coming all the way from France again. Anonymous Attendé asks, can you please give some details about the neighborhood? Is it in a B class or C class? What are the employment opportunities nearby? So maybe talk about the B class, C class thing and employment opportunities. I'm going to pull up the neighborhood in a second once you get rolling here.
Oh yeah, I'm so glad we get to talk about this neighborhood. And for any of you who are following along at home, this would be a great time for you to go onto Google Maps and you can follow along with what Pablo's looking at. I always encourage people to use the resources that you have to figure out how the neighborhoods look and feel. Now, the problem is that most people might look at a neighborhood and they see it differently than what a successful rental property investor might look at, right? So to answer your question, Mr. or Mrs. Anonymous Attendee from France.
Mr. or Mrs. Attendee.
Mr. or Mrs. Attendee.
Yeah.
In France, they don't say their first name when you say Mr. or Mrs. The neighborhoods that we are going to focus on here in Jacksonville for your properties with JWB are going to be your below middle income neighborhoods. I usually don't go down the path of A, B, C, or D just because it's so subjective. What you may say as B might be a C to somebody else or an A or whatever. So I say below middle income. It's a little bit easier for folks to understand. And then it's a little bit easier to objectively to kind of look at.
Yeah. And we're looking at it now, Greg. So
fantastic.
Yeah.
Are we looking at Osteen right here?
We're looking at Osteen right now.
Okay. So what you're going to see for this house on Osteen, as we're looking at it right now, you're going to see a neighborhood that looks like a below middle income neighborhood. Have you seen all those beautiful mobile homes yet?
They're beautiful. Yeah, they're there. I'm doing a 360 view right now. It's there's mobile homes as far as the eye can see.
There we go. Okay. And this is what that street looks like. I think this picture was from a year ago or whatnot, but largely in this area, you're going to see some houses, you're going to see some streets that have a lot of mobile homes on them. Pablo, why would I be fired up about and put my name behind this house on Osteen, a brand new construction home, knowing that there are other mobile homes on that street? Why is that a good thing for this end investor who purchases this one?
You know, my mind, before understanding JWB very well, my mind would go to, as a renter, if I'm looking around, I want to be in this neighborhood, right? Like, because this is my budget, I'm probably going to want to live in the brand new home as a renter, right? So like, you're going to get the creme de la creme of the renter that's in that price range would be the first thing that I would think about.
Yeah. And that's true, right? There's a premium being able to live in a new construction home. That's certainly there. Let's take the approach of the fact that there is no perfect investment out there. I think we can all agree with that, right? There is no perfect investment out there. As investors, we are ranking and prioritizing what's the most important thing for us. And when you're looking at rental properties, we just talked about the number one threshold was positive cash flow, right? That along with your total return on investment, those are what drive me. That's what drives our decisions. That's what hopefully will drive you, because if we focus on return on investment, the best risk-adjusted return on investment, investing in an asset that pays for itself every single month, it's going to help you accomplish that monthly passive income goal that you have, right? If we know that there's no perfect investment out there, then we have to decide what's important for us. Is monthly positive cash flow more important for us? Is your total return on investment more important for us than being in a neighborhood that is the most fantastic neighborhood that has the nicest houses? For me, it is, right? For our clients, it is. But we openly talk about the fact that these neighborhoods that we're going to put you in are not going to be the neighborhoods that have the fancy houses, that have the swimming pools, that have all this. You're going to have houses that have mobile homes will be in the neighborhood. You might have some homes that are in disrepair in the neighborhoods, right? Why am I so excited about that? Because I know what the alternative is. If I prioritize being in a neighborhood that was so beautiful, then I know what would happen. I would be buying houses in neighborhoods where the prices are way high and the rental demand is way low. And there you would find low rents and high prices. And when you have high prices and low rents, you have negative cash flow, which goes against the number one rule of investing in rental properties. These need to be assets rather than liabilities. So we go in and we have this conversation again with all of our new clients coming on board. We're going to talk about neighborhoods in the first call. We're going to say, hey, guess what? These neighborhoods are going to be below middle income neighborhoods. You know, do you see why that's a value to you? Do you see why that's an okay thing, right? We're not asking people to be super excited about investing in neighborhoods specifically because of the way that they look, or maybe they could look a little bit better. We're looking at this holistically and saying, if I am comfortable investing in a below middle income neighborhood, here are the advantages I get. It's an asset, it pays for itself, surrounded by jobs, wonderful management where we can have long-term leases signed, and the overall total return on investment is much higher there. So long answer there. We're going to invest in below middle income neighborhoods. If you had to pin me down for A, B, C, or D, this would be a C neighborhood. And that's very normal. That's where we've been investing since 2006. And that's where I have my money, because it is the best risk-adjusted return on investment. That's our goal.
Before we go into the added benefit of JWB being vertically integrated and working on a neighborhood scale, Margaret Smith puts in the chat, don't like the fact that it seems to me that this will be the nicest property in the neighborhood. But based on what you just said, on a rental property owner investor level, I'm kind of extrapolating to the idea that if you have the nicest property in the neighborhood, it just means that the rest of the neighborhood is going to start getting better. Whereas if you buy into the one where all the houses are already good, then you have less upside in appreciation. Is that a right way to think of it?
No, I really wouldn't go down that path, because then you're starting to bet on the fact that the neighborhood is going to change based on your property. And I don't like to get into that conversation. Could it happen? Yes, we actually have an example of this. We're going to show you guys here in a second. But I wouldn't really go into it with that being a part of the decision. You know, the question, and Margaret, thank you so much for bringing this up. This is on the minds of, I would imagine, most people listening right now. The question is, you know, what you may be saying is, I've heard that you don't want to have the nicest house on the block. You don't want to have the nicest house on the block. For me, I don't really, I want to explore how you get to that idea. Because for me, listen, we build a lot of new construction homes in below middle income neighborhoods, right? This is going to be the nicest house on the block because it's brand new and there's not a lot of other brand new houses in there, right? So it's like, I'm not worried about having the nicest house on the block, right? Having the nicest house on the block may be a good thing, maybe a bad thing, right? It's about what the return on investment is. Right? If the numbers work and you happen to have a brand new construction home, whereas everything around it is not brand new construction, I have no problem with that, right? We shouldn't be villainizing the nicest house on the block just simply because it's the nicest house on the block. It goes back to the same way we make decisions all the time, which is we're making decisions based on the numbers. And the best risk-adjusted return on investment is the best decision for you. So this one is a brand new construction home. There are other homes there. There are other mobile homes in the neighborhood. There are other homes that are a lot older, built in the 50s and 60s. Very few new construction homes is what you'll find in this neighborhood overall, even though JWB is very heavily invested here and has built a number of new construction. But I wouldn't go down this path and just kind of change your ideas just based on it being the nicest house on the block. Go back to the numbers. If the numbers work and the positive cash flow is there and the return on investment from all profit centers hits your goals, boom, that's wonderful. And if it happens to be the nicest house on the block, great. That's how I feel about it.
Makes sense, man. All right. So let's talk about a property that looked like this not that long ago, right?
Yeah.
Let's talk me through this. I'm pulling up 8801 Cocoa Avenue. Give me the story, Greg.
Well, so I was really excited about this topic here, and we wanted, and thank you, Mr. Attende, for the question there, talking about neighborhoods, because I wanted everybody to see the beauty of investing in a below middle income neighborhood. That's what makes this asset class possible. If we didn't invest in that, the numbers aren't going to work, right? It's going to be cash flow negative. So hopefully you guys see the beauty of it and why I get so excited about it and why JWB puts our name behind this as being an incredible asset for you. And you shouldn't be making decisions based on how the neighborhood is going to change. However, when you invest with JWB, you're investing with a vertically integrated provider. A vertically integrated provider is one that invests in one market and goes a mile deep rather than a mile wide, a mile deep in one market, so that we can create inventory opportunities for our clients for many years to come, so they can build out their plans to be able to fill their portfolios with rental properties so they can accomplish their goals, versus going to 15 other markets out there and trying to search for inventory and all that. JWB is focused on Jacksonville specifically. When you do that, you can really have an impact on neighborhoods. So I'm going to play both sides of the fence on this one. I'm going to say, I don't want you to invest in this property or in anything that JWB is doing, saying that the expectation is that JWB has to transform the neighborhood. However, we've been doing this for 15 years. We are so focused on our core neighborhoods. There's just 4 neighborhoods in Jacksonville that we invest in. And we've purchased over 3,000 properties, sold over 2,000 turnkey properties. So by just those numbers, you are going to have instances where you've had a dramatic impact on it. So what are we looking at right now?
Well, right now I've just been poking around Coco. I just went so right now we're looking in 2019 and there's a bunch of cleared out land and a couple of new construction homes.
Yeah.
And then I go to 2015 and you see that there was those new construction homes and like 5 or 6 trailer parks where that cleared out land is.
Cool. When we were looking at this, Pablo and I were looking at this, we're like, wow, doesn't 8623 Osteen Street in, now or a year ago when it took that picture on Google Street View, doesn't that look a lot like 8801 Cocoa, from 5 years ago?
Yep.
Well, 8801 Cocoa is another street that JWB has transformed in Jacksonville in one of our 4 neighborhoods. And clients purchased those homes. 8801 Cocoa is owned by a client. And that client was looking at the street when they purchased the home, and it looked very similar to what you see in Osteen. Now, when you fast forward to 2019 or 2020, and whenever Street View is updated on Cocoa, you see all those mobile homes have been cleared away, and it's land. And those are now JWB properties. And so when you're so vertically integrated and you're so focused on core neighborhoods, you have the opportunity to dramatically impact the neighborhoods. So yeah, I'm playing both sides of the fence there. It's not a bad thing to be investing in a neighborhood with mobile homes, right? If this meets all the criteria for what a successful rental property investment should be, best risk-adjusted return, surrounded by jobs, effective management in place. I'm investing in a lot of neighborhoods that have mobile homes in them. I'm not afraid of it at all, right? But when you invest with a vertically integrated provider, you have an upside there to potentially change the neighborhood dramatically, like we've seen on Cocoa. And I could bring many, many other streets that have been changed and transformed like that as well.
Okay. Excellent, man. I like it. Drew Barnhill in the chat writes that mobile homes are easy to clear out, right? Like if the neighborhood appreciates, it's easy to clear out and build upon it. It makes it easier to change the neighborhood. So that's
one of our secrets for being able to build a lot of new construction inventory.
There you go. Okay. So now I think you're going to love this question too. Don Kick writes, why assume a 0% appreciation rate?
Gosh, that's what I love so much about our show and our community and our group. You guys just get inside the domes of Pablo and I, and you just ask these really great questions that we wanted to share with you anyway. So, and Don, you'll notice that we put 0% in for home price appreciation on the property valuation. Are you queued up there to show the magical?
By mistake, I just freaked out and I shut down the Google Doc. Why don't you talk through, we're right now on this camera. Why don't you talk through the idea of having 0% appreciation?
Yeah. So here's why. All right. If you go back in time, travel back in time pre-Great Recession, from 2001 to 2006, when people are talking about real estate, everybody thought that real estate went up in value every single year, right? Everybody thought it went up in value every single year. I started to build my rental property portfolio in 2006. And when I did that, everybody was like, oh yeah, real estate's going to go up in value everybody thought it. Like lenders thought it, because it had gone up every single year or close to every single year. It really hadn't dropped like it did in the Great Recession. So the entire country didn't really understand how to evaluate home price appreciation as a way of making investment decisions. Then we all lived through the Great Recession, right? 2008 to 2010, home prices fell across the country over 30%. In Jacksonville, they fell over 35%. And we all learned a big lesson there, right? Home prices don't go up every single year. And so what has happened since then is rental property investors specifically have gone the other end of the spectrum, and they'll say, well, geez, I'm not going to count on home price appreciation at all. I can't count on that. I'm never going to count on that. In the face of really significant data points that would tell you otherwise, but you have to know how to evaluate home price appreciation. So the way to do it is to actually take a middle of the road approach, right? What is proven through data is that if you give real estate long enough, a real estate cycle, real estate tends to repeat itself. Values tend to repeat themselves. Home price appreciation tends to repeat itself. And so if you go back and you look historically at what the average home price appreciation rate is for your market, like I know here in Jacksonville, which is 4.3%, and you look over 10, 15, or 20-year segments in time, you're going to find that it's largely repeating itself. It's going to be about 4.3% appreciation when you give it 10, 15-year, 20-year segments in time. So you can't go down this path of looking at home price appreciation and saying, well, next year I know it's going to appreciate at 4% a year, because it might not, it might be more, it might be less, right? But if you give it this full market cycle, 10 to 20 years, you're going to see that history it comes back to the norm. It comes back to that. So the reason why I put 0% there, Don, is because I don't know how long you're going to invest. If you're an investor who has a short-term outlook and you're not planning on investing for a full market cycle, then I don't think you should be counting on home price appreciation. So that's why I put this at 0% here. The other reason is because I'm conservative. I want to make sure I could bring you on as a client and I want to overperform there. And so when I take home price appreciation out here, you can imagine that it does not capture a whole lot of potential return there, which we'll see in just a second here. And then the third reason is because this return, to be able to earn 7 to 9% return on investment, is a wonderful return on investment. If you compare that to the decisions that many of our listeners and many other investors make to put their money in the stock market, it's been shown over time that on average, the stock market returns about 7 to 9% average annually, year over year, right? It's up, it's down, it's up, but over time, it's 7 to 9%. So if you can perform at a 7 to 9% return, not count on home price appreciation here, and have that significant upside, that's what makes me fall in love with rental properties as well. So those are the three reasons there.
So pulled up the sheet, put in 4.3% appreciation because we know we're now investing for the long term. I press enter and well, bam, the magic happens. It goes from 7.9% to 23.26%. You want to explain that?
Gladly. That is why I love smart debt so much. That is why savvy rental property investors use smart debt to create generational wealth. What's happening here is you're investing in an asset that's going up 4% a year, but you only have a small percentage of your money in the deal. And the way that you calculate a return on investment is how much gain divided by how much money did you have in the deal. So very simple way to follow along at home. Let's just say, just because it's easy, that this value of this home was $100,000 and the value goes up 4% in the first year. That means that you earned $4,000 as gain just from the appreciation. That's the equity gain from appreciation. That's $4,000. If you invested with all cash, which means you did not use smart debt, you did not use financing, your return on investment calculation just from the appreciation would be $4,000 divided by $100,000. It'd be the gain divided by how much of your own money you put into it. So that would be a 4% return from the equity from appreciation. You would then add that to the cash flow returns, and that would be how you would get, probably about it would be a 11% return or so if it was a cash investment and you earned 4% in home price appreciation. Now, the reason why this jumps up so much is because we're using smart debt. That same property that you purchase using smart debt, it goes up 4% a year. You still earn $4,000 as the equity gain from home price appreciation. However, you only put 25% down. That means you only put $25,000 down instead of $100,000 down. So now the equation is different. It's 4,000 divided by 25,000, which if you run that equation here, you're going to see that that's a 16% return on investment just from the home price appreciation component. You then add those to the 7 to 9% returns that you would have gotten from the other profit centers. And that's how you get to roughly a 23-24% return on investment there.
23.26. Yeah. The power of leverage, right? Like this is the trick that once we started doing this, it's the number one reason I'm glad we started doing the POTW, right? Because like we got to do this. And before I did not understand when everybody talked about leverage, but the idea that you can get the appreciation on the whole price of the asset based on only putting down 20 or 25%. And then that means that it multiplies your ROI by 4 or 5, depending if it's 20, 25%.
I go back to the conversations you and I used to have. Yeah. And when we were finishing up our runs, and you're like, hey man, you're like, all right, here's what I'm thinking about. You're like, I've got friends of mine that I talk about this because I'm really interested in it. And you're like, but they don't really see a huge win here. Like, and they're really smart guys. They're really up with it. Like, what do you see? You're talking to me. What do you see that they don't see? Right. Yeah. You would talk to me about how, listen, they're not interested in getting $100 a month or $150 a month in cash flow. Right. It just doesn't move the needle for them. Like, Greg, why are you so fired up about an asset that's paying you $150 a month? Whereas my other friends, they look at it and they're like, that's not, I'm not going to pay attention to that. Right. Was it the kicker as far as understanding all of the profit centers along with leverage that turn the channel there?
Yeah, totally, man. Totally. Listen, even this weekend, I was telling you, my best friend was in town and we were talking about it, and the ability to explain that piece, right? Like he was, number one, the buying plan part really helps out as well, right? Like the whole the idea that you reverse engineer from the property being paid off, because that's how you get to the end, and you start with the end in mind, that helps a lot. But then the other part was the understanding of leverage plus appreciation, right? Like the idea, he's like, well, you can't count on home price appreciation. I'm like, no, you can't, right? You can't count on home price appreciation, but you can if it's long-term, and it's 4.3% long-term. Right now, it happens to be at like 12%. So you have upside in the short term for sure. And then once I started explaining it that way, and then it, the light started going on.
Mhm.
So yeah, now that you talk about it, yeah, absolutely. It was the whole, I could not explain it to my friends, and I couldn't explain why just taking a 10% private lending deal was any worse than taking buying a rental income property. Right?
Absolutely.
Makes a lot of sense. All right, man, we got a bunch of questions, man. You
Sweet.
ready to hammer some out?
Yeah, let's do it.
Okay. Mark Larrett writes, so Mark Larrett, who's been around now for a couple of weeks, this is awesome, Mark. He's noticing some trends, right? He writes, the maintenance rate is 4%, but up until now, I've seen 6%. What makes it different here?
What an astute observation there, Mark. Thank you so much for being here. And I know it's been maybe 3, 4, maybe 5 weeks now that you've been back and back and back. That means a lot to us. So thank you so much. And a wonderful question and a really great observation here. So one of the things that's really important is, if you're a new rental property investor, a pitfall to avoid is not properly estimating your maintenance costs. And it's an easy pitfall to fall into. Most people do it because this industry, this space overall, lacks access to real-time information to make educated guesses on what your maintenance costs are going to be. And if you don't have the real-time access to that information, other rental property investors, other realtors that you may work with, they just don't have the access to the information. So they just use guesses, which might not be educated. They tend to use industry standards, which industry standards for something like maintenance cost is a really scary thing to use, in my opinion, because maintenance costs are highly determined by the quality of the construction, the quality of the renovation, and how long your resident stays in your home. That's the biggest driver of maintenance costs. And property manager over here and construction company over here is very different than construction company over here. So how can you use industry standards? And oh, by the way, if the industry was to estimate low on your maintenance costs, Pablo, what effect, if they estimated low on the maintenance cost percentage, what effect would that have on your estimated overall return on investment?
It would make my overall return on investment look more attractive than it actually is.
So they don't have access to this information because they don't track it. And then if they go low, it's going to help their properties look better, help them sell more. Right? This is the pitfall that most rental property investors fall into. We take a different approach. We started to track our actual maintenance costs on every property that our clients purchased since 2011. We have done this now for 10 years. We have over 2,000 properties that clients have purchased, and every single dollar in and every dollar out for maintenance costs, property taxes, everything is there. Maintenance costs is the one I'm going to focus on now, though. So when I put an evaluation in front of you, this is actually backed by a data flywheel. This is a flywheel of data that we have built that continues to feed itself, and we're able to prepare you as a client really well. And what we're able to do is to look at key significant differences that may say that you should expect lower maintenance costs here. And maybe if you're investing in this type of property, maybe you should expect higher maintenance costs, right? And so on the new construction side, you're going to see slightly lower maintenance costs. That's that 4% figure. And when I say 4%, that is taking 4% of the gross rents collected for the year. That's what you should hold back for your expectation for maintenance costs on a new construction property. If we're looking at a renovation, which is what we've shown in Properties of the Week in the past, especially lately, you'll see 6% there for a renovation home that is on city sewer. And then if it's a renovation and it's on a septic tank, you're going to see 9% as your expected maintenance cost. And the really cool thing is that we know that you're going to see slightly higher maintenance costs on a renovation that's on sewer or on septic. And so we know that at JWB, we still have to get to the 7 to 9% return on investment. So we know that we have to buy the property better. If we're going to sell a property that is that is on a septic tank and it's a renovation, or that it's a renovated property that's on sewer, we have to buy it that much lower to make sure that we can renovate it or build it and then sell it to you to make sure that your cash flows are in line, and to make sure your overall return on investment is in line, knowing you're going to have more maintenance costs. So your price has to be lower for you, or your rental income has to be higher for you. Something has to offset that additional maintenance cost. And then when you do that, you don't have to be fearful about investing in septic properties or renovated properties. You just have to know going in what to expect for maintenance costs. And we know because we have that data flywheel.
Data flywheel, man. You just gotta.
I know what gets you going there.
It gets me going. Data flywheel gets me going, man. For those of you that are regulars of the show, I'm a really big fan of Jim Collins. Good to great. Everything he talks about is great. Companies operate from a data flywheel, and it's no secret that I very, very much admire JWB as a company, and the data flywheel just gets my heart pretty pat. All right, Eddie Harris from Hotlanta asks, "Hey, Greg, I read an article that lumber costs have added approximately $36,000 to new home purchases. Are you seeing this with new builds for JWB? And do you see this cost coming down in the near future?"
Yes, very timely question, Eddie. Lumber costs are insane right now, and builders are their costs are going up substantially. It's not $36,000 is true for that. It totally depends on the type of house you're building. It's not a $36,000 increase for JWB's homes. That would be quite substantial, but it is substantial. Probably somewhere in the line of $5,000 to $10,000 more to build the house than what it was in October of last year. So that is very significant, and it's really interesting. So the reason that this all started to happen was because of COVID and supply chain issues, and a lot of lumber mills shut down. And then since then, we've been dealing with COVID for a year now, they have ramped back up. Obviously, home building is on fire, and they've ramped back up. And you would think that the supply chain issues have been resolved for the most part, but prices for lumber are just going up astronomically. So it's forcing builders to see what they can control, because builders look at this and they say, listen, the only way to solve the supply issue is through builders coming in and building out hundreds and hundreds and thousands of homes in a community, right? Right now we have such low supply. You're not going to solve the supply issue by Susie homeowner and every homeowner down the line just putting their house on the market for sale, right? You need builders to come in and build at scale. So builders are looking at this and they're saying, listen, maybe we don't build out all these homes that we were thinking about building out, because lumber prices are so much higher than what they should be right now. And we feel like the lumber companies are keeping it high because they feel like they can. So builders are now scaling back. You're going to see that builders are not building as much as they could sell right now, because builders know, listen, if we don't build a lot, the supply doesn't go up. If the supply doesn't go up, home price appreciation continues to happen. So it's almost like you've got this duel going on between lumber companies and home builders. And I don't really know how I don't really know how this is going to work. Eventually you would expect lumber prices would go down because they just shouldn't have risen as much as they have recently, but they're both kind of playing chicken right now. And, so we hope that it comes down over the next 3 to 6 months. I don't know though. We're all kind of along for the ride.
Yeah, that was interesting when Alex brought it up at the call a couple of weeks ago. It's like an OPEC situation.
Yeah, exactly.
A couple of players are controlling one commodity in a market and causing a game of chicken. It's kind of fascinating market dynamics. All right, Raja Bantu has this property. Let me share it again. This property is priced higher, $157 per square foot, based on square foot basis. Is there any specific reason for it?
Yeah, absolutely. So this property is priced at $190,000, and this is priced on comparable sales in that area. And that's how every JWB property is sold. So this home is priced because other homes in that area, in that neighborhood, have sold for a similar price per square foot. And that's the way any appraiser is going to evaluate this property. And of course, if you get conventional financing when you purchase this home, then you do have to get an appraisal. And the appraiser is going to look on the multiple listing service and say, okay, well, JWB and maybe Raja bought this home, let's just say. Well, they'll say, okay, well, it's good that you guys have agreed on a price of $190,000. Now let me make sure I go and justify the value out there. And they're going to look on the MLS and see what other homes have sold in that area. And then our commitment to you is that the sales price is going to match the appraised amount. So you're protected there. And this home at $190,000, you really just got to look at what everything else is selling for in the area, which is something that we can provide that information to you. And you're definitely going to get that information when the home goes through an appraisal.
All right, there you go. Something is blocking part of the screen while I'm doing this, and I'm trying to fix it while we're flying here. The gray box is at the top. Okay, well, we'll figure that out in a second. Let's ask one more question. Andrew Barnhill has a question. Is it hard to get the appraisal to come in a neighborhood like this?
So the question is it hard for an appraisal to come in a neighborhood like this? I'm going to focus on the part of it where he says like this. There is nothing different about this neighborhood than any other neighborhood that JWB operates in. In fact, overall, Jacksonville, compared to other cash flow markets, has so many things that are selling that it's easier to get appraisals to come in here than other markets where, you know, things just don't really sell. If it's in a market where it's all investor driven and there's not many sales, or there's a lot of foreclosures or whatnot, then it'd be harder for an appraiser to go about appraising a property. So nothing about this neighborhood is going to make it harder than another JWB neighborhood. There's a ton of sales that are happening. However, if I just focus on appraisals today versus appraisals 6 months ago, there is a big difference. And this is what happens in a rapidly appreciating market. If you think about how an appraisal works, an appraiser is looking at what has just sold. So they are backwards looking. They're looking at properties that the price was agreed upon, I don't know, a month to 2 months ago. And then it went through the loan process. And then the home is sold. It's closed out on the MLS because a closed comp. And then they're using that to justify value, which is the way that it's always been done. And it works really well when your market is going up like a normal market goes up. Let's just say on average, 4%, a year, right? Well, when you get into a rapidly appreciating market, last year to this year, year over year, the 6-month trailing average for home price appreciation in Jacksonville is over 11%. That's rapidly appreciating. That's 1% a month, let's call it, right? That's rapidly appreciating. The idea of looking backwards at comps to justify decisions that are made today is tougher. You also have this incentive that appraisers are never going to get a pat on the back from the bank for an appraisal coming in high, right? If the appraiser comes in high, more than the market value, the lender, if they have to take that property back, they're going to look at that appraiser and say, you shouldn't have done that. You inflated the value, and there's very big risks to an appraiser if a bank would, if many banks would come down on them as having high appraisals. So an appraiser is going to be incentivized to hit the number or to be low on the number. So you've got these two big things that are happening, especially in a rapidly appreciating market. And what it's forcing is a lot more low appraisals today than there were 6 months ago. And you're going to see this in Jacksonville. You're going to see this in all of your markets out there right now. This is a common thing across all markets because appraisers are backwards looking by definition. Prices are going up a lot more, and there's an incentive for an appraiser to be right on the number or below. And so for us here at JWB, we're going to make sure that you're treated fairly if there's a low appraisal, and that we're treated fairly as a low appraisal. In fact, we have this conversation well before we even go through property selection with you. And the conversation is, hey, listen, these are all the great things that can happen. These are all the bad things that can happen when you go through a loan, when you have a property that's put under contract. One of the negative items that can happen is a low appraisal. Here's what we're going to do. In that case, if a low appraisal comes in, it's still pretty rare, right? Geez. I mean, historically, over 90% of our appraisals come in. So it's still very, very rare. But if it happens for you and you get a low appraisal, here's what we're going to do. You have the option to go forward with a second appraisal, which actually requires you to go through a complete second loan process. So we're going to facilitate this for you. We're going to go down that path. Some things to think about. You'll have to pay for another appraisal, which typically about $500 or so. Some banks require 2 appraisals. So $500 maybe to $1,000 is what you'll need to pay for. Again, those are the additional costs if you choose to go down that route. You'll have some extra work, right? You'll still be going through a loan. You'll have to get extra bank statements and documents and all this good stuff. So it's maybe another 30 days of work. And if you want to go down that path, we're going to go down that path with you. We're going to support you. It's extra work for JWB. We're happy to support you there. We're going to be a resource for you if you want to go down that path. The alternative is that you could bring the difference to closing. And if you decide to do that, that might be the best thing for you. We're going to let the return on investment really guide us here. So like, for example, if the appraisal is off by $2,000, maybe upwards to $5,000, right? You can look at it and say, well, I might have to spend another $500 to $1,000 to go down the route of the second appraisal, right? And then I'm looking at the time that I have to invest in this. And I'm looking at the fact that I now have to requalify for an interest rate again.
Mhm.
And you might say it makes more sense for me to bring the difference to closing to purchase the property. A lot of clients make that decision, especially if it's off by a relatively small amount. So the option is there, right? You can go down one of those two options. We're going to support you. Again, a low appraisal is relatively rare, but we want you to know what are the potential pitfalls and how we'll both treat each other fairly if that should happen. And, before going under contract with you, we're going to ask for your commitment that you're ready, willing, and able to do one of those two things. What we don't want to do is put a property under contract, know the risks that go along with it. If something negative might happen that we've talked about ahead of time and prepared for, and then not go down that path, because what we have done is just tied up inventory for 3 weeks, 4 weeks, 5 weeks, 6 weeks. And ultimately there are better ways for us to work together to solve the problem.
Yeah, that makes a lot of sense. You're always looking for the best win-win-win scenario, right? So that seems to be pretty fair. All right. So Don Kick, back to camera one over here. Don Kick says, thank you for the other question. Can I ask another question? All right, I'm going to start over this because I'm tripping all over my tongue right now. Don Kick asks, you mentioned that home prices declined by 35% during the Great Recession. During that same time, how much did rents decrease?
Great question. I know firsthand how this felt, because in 2006 is when I started to build my own rental property portfolio with my business partners. So if you can imagine 4, 23-year-olds starting to buy rental properties, that was us. We were really, really fired up, read some books, had some mentors, didn't have any money, but borrowed a lot and put all on the line there, only to find out that home prices fell, as you mentioned, 35% in the coming years. I learned early on the value of investing in an asset that pays for itself every single month and not investing on speculation, which is, again, why when we started this call, we talked about number one, buying assets that pay for itself is the first threshold. When I bought those assets, they paid for themselves, $100 a month, $150 a month, whatever it was. And when the values went down, meaning the home values went down from 2008 to 2010, the home values went down 35%, rents stayed consistent. So if you think about why I was able to own those 40 rental properties and hold on to those rental properties and not give them back to the bank, and I still own those rental properties today and have been able to add on more and more and more, it's because they paid for themselves every single month. They brought me cash flow. In the midst of the Great Recession, I had 40 assets out there that were paying me every single month, $100 a month, $200 a month, whatever it was. So that's one. I'm so thankful I learned that lesson early on through my mentors, through my education. That was the difference. Whereas everybody else was so fired up to go and buy rental properties today that didn't in 2006, at that point, they were buying them. Didn't matter about the cash flow. They didn't care about it. They were buying it to sell it for $20,000 more in 3 months. Those are the people who bought 40 of those and then took a big bath and had to give all those properties back. So rents do not move in line with home prices, right? It was a different variation at that point. You had the Great Recession, which tanked home prices, but jobs still stayed strong in Jacksonville. Your major job creators were still here. People still had jobs, and therefore they could pay the rents, and people, of course, need to play, and rent stayed consistent.
I'm glad you brought up jobs, because I think there is a couple of other variables to that equation, right? Like, so rent stayed consistent. In Miami, there was all these new apartments in downtown, right? Like Brickell had blown up. There was these like brand new buildings that were like 20% occupied. It looked kind of terrifying, right?
Yeah.
But you kept rents consistent and you kept occupation up. Can you talk a little bit about the factors in Jacksonville that affect that, from the asset class being where you guys are positioned of who you house, and also what the economic mix is here?
Yeah, let's go back to why we love investing in neighborhoods that may have mobile homes in them, right? Why do we love to invest in below middle income neighborhoods? It's because, as I've mentioned many, many times, it's the best risk-adjusted return on investment, right? So Brickell in South Florida, right? I don't know it all that well, but is it more upscale?
Oh yeah.
Yeah. Okay.
It's expensive.
There you go, right? You saw those big high rises there where they had all these condos or apartment complexes built out. And then when the music stopped, right, those remained vacant for a long time, because at that point, people were investing in upper class housing, right? They were investing in apartments that were not below middle income, right? In condos, not below middle income. So when you invest in the nicer neighborhoods, you're going to find that that risk mitigation is not nearly as strong, right? So in Jacksonville, we invest in the below middle income housing. And that means that that housing is going to be strong because the numbers work, right? Like the rents there they're strong rents. It's high rents compared to the purchase prices. But overall, that's not Brickell type rent.
Correct.
You know?
Yep.
Right? Like we're talking about $900 to roughly $1,500 rents here in our below middle income neighborhoods, right? In Brickell, I don't know what the rents would be, but way more than what the median rent would be in Brickell.
Yeah, I mean, you'd be looking at like $1,500 back then for like a 1-bedroom apartment.
There you go. We're talking about 4-bedroom, 3-bath homes.
Yeah.
So another reason why we love the below middle income neighborhood, you got to get over what it looks like, right? You got to stop putting yourself as the resident. You have this opportunity to create a great value for a resident, to be able to provide the best value for them to be able to rent in this neighborhood. And you are not your resident, right? That's the way that we look at it.
Got it. Yep. That makes sense. And it also, when I think about the things that we speak about on the show of the Jacksonville economy and it being heavily government, right? Like there's a lot of military, there's logistics, there's healthcare, there's finance and fintech. I look at the Miami economy, which is heavily driven by tourism and real estate. And, all these other sectors have grown in Miami since, but back then they really weren't there. I also think of a much less boom and bust kind of equation of what supplies that housing. But I think you're right. Those $1,500 1-bedroom apartments in an urban center where all the cool restaurants are is not where the garage door opener installer's family is living. And, like it's, like these like services that we need that are always going to have a job.
Mm-hmm.
That's where this lives, right?
Exactly. What's going to be the first to experience the decline? Those rents in that Brickell type neighborhood or your blue collar housing in below middle income neighborhoods. That's going to be there, as long as that's going to be the last to go.
Yeah.
There you go.
Makes sense. And that played out during the coronavirus too, right?
Exactly.
Yeah. 1:43, Greg, how you doing?
I got to jump on a training here at 2, do a little bit of prep there. So maybe another 5 minutes.
Another 5 minutes. Let's do it.
Cool.
Anonymous Satende has another question. Is the 7.6% ROI the same as cash on cash return?
It is not. It is not the same as cash on cash return. And the reality is that rental property investors and turnkey companies and vertically integrated companies, there are different ways to analyze deals. You need to pick one and you need to find a way to compare apples to apples. And so if you're going with the traditionally accepted cash on cash return metric, what you're doing is you're taking everything that's hitting your bank account and you're also counting in expectations for maintenance and vacancy costs, which is not exactly what we do here, right? We feel like this is a better representation than that because this takes into account all 5 profit centers. But traditional cash on cash return, if I was to take it into account here, you would basically take your gross rental income, you'd subtract out your principal, your interest, your taxes, your insurance costs, your property management costs. You would take into account your tenant placement fees, which again, there's a lot of variation. Do you take in the full brunt of the tenant placement fees? Do you do it once every 4 years? Do you only take a quarter of the tenant placement fee? Whatever. There's a lot of different ways. And then you take into account your maintenance and your vacancy costs, even though they don't hit every single month, you would take that out. And then you would not look at the other profit centers as well. You would not look at home price appreciation. You would not look at tax savings. You would not look at principal pay down, and you would not look at inflation hedging. If I was to do that and to take all that around, you're going to see that it's going to be, and I would probably used 25% of the, I'm just going to ballpark. It's going to be somewhere between 0% to maybe 2% cash on cash return, depending on how you may look at it. If you're only looking at the negative items and you're not looking at the other profit centers.
Okay, there you go. Roger Evans, this should be a quick one. What does the acronym PBTS represent?
Great question. PBTS is your performance-based septic system. And so when you're looking at as an inventory provider, it's tough to find inventory right now, right? You have to constantly be searching for ways to turn pieces into cash flowing assets. One of the ways that we've figured out how to do this is to be able to work with relatively small lots. Like a standard lot in Jacksonville is 5,000 square feet, 50 by 100, 50 frontage by 100 in the back. That's your 5,000 square foot lot. Well, we're able to work with lots that are a lot smaller. They might be 35 feet. And when you can build homes on 35-foot lots, that's going to be able to take a piece of land or more pieces of land and turn those into assets, which then become part of the 600 homes that JWB is building this year. That's how one of our resources for being able to build out a runway of rental properties, whereas everybody else can't find any inventory. Now, when you build properties on smaller lots and it's on a septic system, you typically need a lot of land to house a traditional septic system. So we have figured out a way, we've done this for many, many years now, to use what's called a performance-based septic system. It's engineered differently to be able to work on a smaller lot. And in order to do that, there are certain costs that come into play. So they have like annual service agreements to make sure that it's up to speed and that you don't have additional costs coming your way. So for JWB, PBTS should mean to you that it is a performance-based septic system. It's a special septic system that goes onto your property, and that it's going to come along with fees every single year. And so the fees for your performance-based septic system and your water treatment fees. So this one, again, kind of not to go off a tangent here, but we know enough about the neighborhood to know that we need to include water treatment in the property for the resident to have a great experience. That's going to come out to about $275 a year there for your PBTS and your water treatment fees. We give this to you ahead of time. You know this going in, it's factored into your return on investment, and now you're prepared.
There you go. All right, Greg, last question from Lee Bishop, MVP of the Not Your Average Investor Show. He says, Greg, I have a property coming up at the end of the year for a turn. The average I have to have in my reserves to cover this is about 4,000, right? Can you talk about what's involved with that?
Yeah, absolutely. Lee, congratulations, brother. The newest edition. The team was so fired up for you. I got wind of the newest property for you. So congratulations. Very cool for us to be thinking ahead, especially as far as reserves. The one thing, Lee, I know about your portfolio, a lot of what you have is in your retirement accounts. And so that's the only variation I'm going to give to maybe what my normal answer would be. My normal answer would be that you need to have 6 to maybe 12 months of expenses in your retirement, or in your reserve account for your properties, right? And if you have multiple properties, you don't need to have 6 months of expenses or 12 months of expenses for every single property, because if you have multiple properties, you're going to have most of, the ones that aren't going through a turn are going to be kicking off cash flow for you and all that. So 6 to 12 months for one property is what I would recommend if it's outside of a retirement account. And if your expenses are, $800 or whatnot a month, think about maybe depending on it, right? 4 to maybe 8 grand for your reserve account is probably what you should keep liquid and there for your, if something happens. Fun. Now, Lee, for you, you're in a retirement account. I would make sure that it's more than that, because in a retirement account, if you don't have enough reserves and you can't pay for a property turn, it's a bad thing, right? In retirement accounts, when you buy properties, all of the money that you spend on maintenance items, all of the good things that happen with rents coming in has to go into that retirement account, and you can't commingle funds. You can't take personal money from Lee to be able to put into your retirement, to pay for your retirement account properties. So Lee, what I would recommend is probably go more on the high side there. You do have a lot of properties with us, which is really fantastic. So, I would say probably somewhere around maybe 6 to 8 in the reserve account specifically for that retirement account is probably great for you. And, depending on the cash flow you're earning from your other properties with us, it could be a little bit less, but there you go.
There you go, Lee. And for anybody that has specific questions like that, the best move is go to chatwithjwb.com, pick a call with, pick a time to talk to Courtney and the team. And if you have a question and you're not a client yet, and you just want to know generally for your situation, whether you're thinking in retirement or you're thinking in just cash or you're financing, how much to have extra, kind of get the ball rolling. The move is to go to chatwithjwb.com. And anybody that's new, I just saw Tom Albrecht here in the chat says, new to JWB. We'll see you all next time. If you're new here, you haven't heard about our Facebook group. We've got a Facebook group. It's got 2,600 investors, really savvy people, honest people. They're giving value. Greg's in there all the time, giving value as well. So we'd love to have you there. Go to jwbfacebookgroup.com. And last but not least, next week, we got an interesting call next week.
Oh man,
GC,
super excited.
You want to tell us about it?
So a lot of clients have been taking advantage of a cash out refinance. And for those who are familiar with cash out refinances, you're probably you're seeing this huge opportunity to lower your interest rates, to be able to pull cash out of the equity that you have in your properties. And we have a really great client case study of one of our longtime clients, Adam Walbarsh, who's going to be joining us. Adam just did a cash out refinance. And we're going to talk about how he was able to go from 4 JWB properties to potentially even getting to 8 JWB properties without bringing any of his own money to the table. And that's what the possibility is for this cash out refinance. It's not very common to be able to, again, grow your portfolio like that without you bringing additional money to the table, and also to lower your interest rate and potentially even lower your payments as well. So super, I don't know what the right word is. I'm really excited. Like, this could be a really foundational call for those who have been investing in rental properties for a while, who also have a buying plan that might see that they need to buy in 3 years or 5 years. You might be able to speed that thing up and do it very, very quickly here.
Yeah, I think the word valuable, right? Like, it's going to be a super valuable call. If you've been a client with JWB and you've been around, you've had a property for like 5 to 10 years, you know, the cash out refi right now, based on interest rates, based on where appreciation has been just this last year, which just went in freaking overdrive.
Yep.
You know, there's probably an opportunity there. This is a really, really low friction way to find out more about that. Just show up, listen to the call, listen to his story. I think it's going to be really, really cool. Greg, we did it, man. First call in studio, me and you, brother.
Boom.
Yeah.
Awesome.
Yeah. I mean, Thursday afternoon, we had 60 plus people with us the whole time. We still got 46 people. We're like an hour and a half in. That never goes unnoticed by us. The like, people showing up, being part of this community. This show is driven by you, driven by your curiosity, driven by your participation, driven by your want to grow your wealth and grow a portfolio and change your life. So it's really, really an honor to be here. Greg, I'll give you last word.
Thank you all for being here. Thank you for allowing us to work our way through the first in-studio session here. We're super excited about it and just really appreciate the folks continuing to come back, supporting the show, supporting the group, and the new folks who come here now and are fully welcome and ingratiated into the process. We just love having you. So thank you guys so much, and we'll see you on Tuesday.